Last week, we touched on the issue of the valuation of the UK stock market on the basis of market cap to GDP, or in other words, the total stock market worth of all London quoted firms relative to our country's economic output. Now, the results put a bit of a question mark over the long-term direction of stocks, given that on this metric the UK looked relatively expensive compared to its own history, unless corporate profitability and efficiency keeps improving from what are already pretty much record high levels. Now this week I'm going to take a step back, look at a different valuation tool, one that suggests UK stocks might actually be quite cheap relative to their history, though again there are a couple of caveats. Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Breaking the Mould, a regular look at the financial markets. Now, dividends tend to be a bit more predictable than earnings, as company bosses are generally reluctant to cut them. It may hit their own pocket for starters, and also attract a lot of criticism from frustrated shareholders. This means dividend yield can be one useful valuation tool, providing you have a long enough trading history, and we certainly have that for the FTSE All-Share Index as a whole. Now remember, in simple terms, the higher the index, the lower the yield, just as is the case for a share price and a bond price for that matter. So one potential signal for the market could be when the yield looks especially juicy. That could potentially suggest the index has fallen too far. Now the first chart here shows the FTSE All-Share and its dividend yield back to 1986. The flat line is the long-term average, that's 3.5%, against a 3.62% on offer as I sit here today. Now that may suggest the All-Share and UK stocks are a touch on the cheap side relative to history, even allowing for the fact that that history is no guarantee for the future. But it's when you look at other potential sources of income the data look a bit more intriguing. Cash in the bank is generating 0.5% a year, at least as defined by the Bank of England base rate. The 10-year government bond, or gilt, is offering a yield of 1.95% at the time where I'm sitting here. And since the UK last jiggled its debt payment terms around the 1930s, you should get your interest payments and money back on the original loan in the end from the British government. This chart here shows the 10-year gilt yield over the sort of post-1986 period. Yields have basically fallen, prices risen pretty much consistently. Now the dividend yield on the All-Share of 3.62% beats both cash and the 10-year gilt, with the caveat your capital is at much greater risk in the stock market than it is in bonds or cash, because shares can go down as well as up. The question then is, does the return from shares compensate you for those extra risks? Well, one way of checking this is to look at the dividend yield relative to the gilt yield. Here's the result, and as you can see, this figure's quite high by historic standards. Shares offer more than gilts in a yield sense by some 170 basis points, or 1.7%. Until 6 years ago, bonds pretty much always yielded more, when the chart in this case goes below zero. Now if you run that chart against the FTSE All-Share, you'll see that whenever the equity dividend yield premium has reached 2%, well, it's done it 3 times in the last 6 years. In 2008 and 2012, it actually proved to be quite a good time to buy as the FTSE All-Share Index subsequently rose. The third time was August the 24th of this year, the day of the big summer panic. Let's see. This chart runs the All-Share against the bond minus dividend yield, and the rings highlight when the gap reached plus 2% in favour of equities. Okay, now there are clear risks and caveats here. 1. If the Bank of England raises interest rates, bond yields are likely to rise and the gap to close, lessening the valuation attraction of stocks relative to history. Also, firms can and do cut their dividends. Glencore, Tesco, Morrison and Centrica have all done it recently, and they're all FTSE 100 firms. More of that could reduce the dividend yield attraction of stocks as well in absolute and relative terms. And again, to repeat, there are no guarantees for the future just because the past data look good. This does again finally highlight the importance of interest rates and how they can influence share prices, and may do so again if and when the Bank of England starts to make a move and tighten monetary policy by raising rates. Thank you for watching, and I look forward to seeing you next time.